Okay, so if you're a developer in the crypto space, I bet you've had this thought. With all these exchanges, all these price feeds, there has to be a way to write a script that just prints money, right? It's the ultimate dream, turning your code directly into cash.
But is it really that simple? Is there just free money out there, hiding in the markets waiting for a smart algorithm to come scoop it up? Well, in this explainer, we're going to take a journey from that elegant theory to the brutal reality. And then we're going to find a path that actually works.
All right, so let's start with the dream itself. It has a name, triangular arbitrage, and on paper it is one of the most beautiful, elegant concepts in all of finance.
And what's so appealing here is just how simple the mental model is. You just get the market prices, you build a simple graph where all the currencies are points, and then you find these little loops. You trade from currency A to B, B to C, and then C right back to A. You compute the profit, and if you have more than you started with, bam, you found free money. It's just pure math. It feels inevitable.
So how does this actually work when you sit down to code it? Well, if you've ever tried building this, and I'm guessing some of you have, you know that the second you start pulling real data, you have to make a really important decision.
Do you go the fast, kind of optimistic way and just use the top-level ticker prices? This gives you a quick snapshot, sure, but it ignores a really crucial detail. Or do you go the slower, much more realistic route and actually simulate your trade against the live order book? This method accounts for the real liquidity that's actually available at any given price point.
And this right here is exactly why that realism matters so much. The concept is called slippage. See, when you actually try to execute a trade, say for a couple $100 worth, you might use up all the liquidity at the best price, and the rest of your order gets filled at a worse price. That little difference between the price you expected and the price you actually got, that's slippage. And it's one of the first hidden costs that starts to just chew away at your theoretical profit.
Okay, so you've done the hard work. You built your more realistic bot that simulates against the order book. You've factored in the trading fees, you've accounted for slippage, you hit run, and then you just hit a brick wall. This is the billion-dollar reality check.
You see a number like this. After all that elegant code, you find out that a typical trade cycle actually loses you about 0.8%. Your script isn't printing money, it's consistently burning it. So after all that effort, why? Why did the script lose money when the theory was so perfect? And here it is. This is the fundamental truth. You were so focused on building the perfect model, but the real game was never about the model. The huge edge that the big firms have comes down to three things: latency, fees, and capital efficiency. They are playing a completely different game than you are. I mean, just think about what that really means. They have their servers physically located inside the exchange's data center. That gives them a speed advantage measured in microseconds. They have special, negotiated fee tiers that you will never get access to. They can tap into these deep pools of liquidity. Put simply, you cannot beat them by being smarter. You can only lose by trying to be faster.
Now, I know this might sound super discouraging, but it's actually the most important lesson you can learn. Because once you understand that you can't win their game, you can start looking for the game that you can actually win. And that's where your skills as a developer become your true superpower.
You've heard that old saying about the gold rush, right? The people who got truly rich weren't the ones digging for gold. They were the ones selling the picks and shovels. It is the exact same thing here. Instead of trying to find the gold yourself, you build the tools that other traders need to do their jobs more effectively.
And this is where your edge really is. It's not in microsecond speed, it's in clever engineering and being adaptive. You can build systems to detect when an exchange's price feed goes stale, or find those strange inefficiencies when Bitcoin is priced differently on Kraken versus Binance. These are engineering problems, not latency problems, and the solutions are incredibly valuable.
So this means you need to reframe your whole goal. The arbitrage bot you built isn't a failure, it's a prototype. It's not a money printer, it's an incredibly powerful sensor for measuring the market's health, its stress, and its inefficiencies. And that sensor, that is a product you can sell.
Okay, so how do we actually turn that sensor into a product? Let's walk through a concrete blueprint to build something you can actually start selling to people.
We'll give it a name, the CEX Inefficiency Monitor. The name says it all, right? It watches centralized exchanges and it flags anomalies. It's not promising free money, it's promising valuable, actionable information. And that is a credible product that professional traders immediately understand the need for. For your minimum viable product, you can focus on three incredibly valuable signals. First up, price divergence, just flagging when an asset is way cheaper on one exchange than another. Second, spread health, watching the gap between the buy and sell price to spot when liquidity is drying up.
And third, triangle friction. This is where you use your original arbitrage code as a stress test. If that normal negative 0.8% loss suddenly improves to, say, negative 0.3%, something weird is happening in the market, and traders will pay to know about it.
And the path to actually building this is really straightforward. You start small, collect data from just 2 or 3 exchanges, then you compute those 3 core signals we just talked about. You store snapshots of the data in a database so you can show historical trends. And finally, the most important part, you send out alerts on Telegram or email and put it all on a simple dashboard. That right there, that's a sellable product.
You can even start to think about what to charge. Maybe a starter tier for serious retail traders, a pro tier for the more advanced folks, and then a desk tier for small funds or trading firms. This isn't a dream. This is a realistic business model built on the foundation of the code you've likely already written.
So let's end on this thought. The arbitrage code you wrote wasn't a failed attempt at a money printer. It's the engine for a powerful market sensor. The real question isn't where's the free money anymore. The question is, what valuable inefficiency will you measure first? Because that is the game you can absolutely win.